Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I am your host, Paul Peebles, national underwriter for Old Capital, and typically would be Michael Becker, but he is on another due diligence property walk tour today. So we wish him the best with that one. So joining me today, of course, James Eng. Hey, James, how are you?
Hey, Paul. Thanks for having me.
Also with Old Capital. So we're going to hear an interesting story today. We have two of our friends that have closed two transactions with us recently. And it's really an interesting story that these guys tell. They're engineers. They came over from India back about 21 years ago. Mm-hmm. And just really entrepreneurs. I mean, one of the guys who lives out in San Jose was part of 5 startups. Another guy here sitting right next to him is just an IT guy, but they're both engineers. But they're engineers with entrepreneurial background. So we really want to kind of figure out, where does that spark come from? So in the podcast today, we are our friends Menon and Ajay. Thanks for being in the podcast, guys. We appreciate it.
Yeah, thanks.
Thank you, Paul.
So let's kind of kick it off. James, let's get it going.
Sure. So maybe start off with Menon. Maybe give us a little bit of your background and then how you got started in multifamily.
Thanks a lot, Paul and James. We are grateful that you guys are giving us an opportunity to come over here. So thank you for that. So I'm from India, like Paul mentioned. I came in 95, did my master's here and did the typical, joined Oracle and then worked in Oracle and got my green card. And I've done an MBA from Berkeley at the same time. And I also wrote a technical book, which did pretty well. But anyways, that was a technical aspect of my life. From Oracle, I went to Netflix, and we are talking about Netflix when Blockbuster was our biggest threat, which I don't think people even remember Blockbuster now. So around 2.5 years, I worked in Netflix, and I decided to do my own company, and I ended up co-founding 5 startups. One of them we sold, but we didn't really make a whole lot of, in terms of money. So once I went back to job after around 3 months or so, I felt like I want to do something of my own. So I explored real estate, did a few flips, and found one mentor in San Francisco and came over here on a random email from some guy to attend Brad's R2R. And I decided to go with Brad, and that's how
the rest is history. Jay, maybe tell us a little bit about your background and how you got started in multifamily.
Yes, so I came like 1 year after Menon, because Menon came in 95, I came in 96. So I came in California, so I stayed there around 2 years in LA area, and then I moved to Houston. So Houston, I got a job with the energy company, El Paso Energy, that used to be at the time, and I stayed there around 6 years. When this whole Enron mess up was going on, then I got a job with Deloitte and Touche here in Dallas, and then I stayed with Deloitte for 6 years. Did a lot of travel, and then I joined a startup company here also. So after that, this job was going on. So what I started, I joined. My first experience with real estate was a weekend seminar with Del Walmsley from old Lifestyle.
Sure.
So he, in this seminar, basically he taught how to invest in the single family home. So after that, I didn't join Lifestyle like a full time, just like that their basic, the foundation program. That's what I did, and then I bought 6 or 7 single family homes. And for a couple of years, I didn't do anything because the single family homes were doing so good, and almost triple the money in those single family homes. Still, I have those. It's like my wife keeps saying those are our good luck homes. So she's keeping those.
Okay.
Yeah.
Great.
And then in 2014, I went to REI Expo in Gray Point. So I was planning to attend a different seminar, and I signed up for that one. When I went there, the seminar was full. There was no seat to sit. So me and my wife were standing outside. And then at the time, like there was a nice lady standing outside, and she was asking us like what we do and what our backgrounds, and we told her this is what we do. And she asked her why you guys are here. So we told her that this is a seminar we wanted to go. And she said, come with me, and then let's hear what we have to say. And it was so by luck, there was a Brad Sumrock speaking on that time.
Okay.
And we heard him. And next month we joined his foundation program. And then after that, we started investing in the real estate, in the multifamily as a passive. So after 1 year, I upgraded to his personal student. And now at this point, I have 3 deals as a deal sponsor. And I am like a passive investor almost in 3,000 units.
Okay, great. So maybe talk about, so when you first joined, started looking at multifamily, maybe talk about the process of going from a passive to now a lead. What was that like? And then how did you guys decide to do that?
So I also was just like Ajay. When I joined Brad Sumrock's group, I decided to go with passive because I wanted to see whether it's real or not. I was hearing so many stories, so I trusted, but still I wanted to put my money. So I did 2 passive deals, but in the back of my mind, I always wanted to do the deal sponsorship. So I straight away joined as a personal mentor program.
Okay.
And once I had seen a few results, I mean, cash flow coming in, so I thought, okay, this is real stuff. I thought, okay, I started. So I was in a startup at that time, and I was in that startup for I think 1.5 to 2 years. So during that time, I started looking for deals, and I decided that I started analyzing deals and looking for deals and making offers and stumbling over things and making mistakes. And Brad was there for me throughout. I mean, I would have calls with Brad Sumrock on the fact that I'm stuck. What do I do, right? So he will guide me on that. Okay, you have to put brokers on schedule. You have to call them again and again and all that stuff. So at every step of the way, Brad Sumrock was there for us.
So how many, Jay, maybe you can take this. How many deals did you have to analyze and underwrite before, let's say, the Carlton came about, in terms of how many offers did you guys have to make? Because I want to give people an idea of what it takes to be a general partner in these deals. And some people think that, they're going to set a deadline of, 3 months and make a couple offers and then they're ready to go. So let's give people an idea of what it takes when you're a general partner to put these deals together sometimes.
Yeah. So before Carlton, I had another deal in Mesquite in 2016, which me and Mike Hardies, we co-sponsored that. And that deal was an off-market deal. But to answer your question, like if you try to put a number, I would say you have to analyze a lot of deal. It's not like because think about, just to put something in perspective. Before Carlton, I used to at least analyze 1 deal at least every day.
Okay.
That's what I would say. Out of those deals, like let's say you analyze, I would say 20 deals. Out of 20 deals, you will have 2 or 3 deals which you really want to go for. And then after that, you basically, because for us, the advantage which we have a analyzer and guidelines from Brad Sumrock. And that helps us a lot, because that helps us to weed out a lot of deals which does not make sense. And we have something called we created this not a real analyzer, but something like a back of napkin analyzer. So if you give me a deal, I can put some number in a deal, and within 10 minutes I can tell you whether you want to go for it or not.
Okay.
So those kind of analysis we did a lot. And because after that, me and Menon started working together. So we used to, like, my wife always says that, Menon look like your second wife. Because I talk to Menon more than my wife, because the moment I'm home, and so we will be on the call, going through the numbers, and I share the screen and go through. So we always make sure if I underwrote a deal, he will analyze. If he did, then I will analyze. And then after that couple of iterations, then we go to Brad or one of his coach. Okay. That's how we do. But
So you guys are partners in these transactions, but Menon, you're married. Jay, you're married.
Yeah.
Menon, you live up in the Bay Area. You live in
Dallas,
Texas. Mm-hmm. How did you guys come together? Was it Brad's event that you came together on? Is that how you guys met?
So once I was a personal mentor, I was pretty serious about this. So I used to attend all the bus tours, and one of those events, I don't know which one, I met Ajay. And that's how we met. And I had met several people before that. I was partnered with Kevin Dillon. He's a great guy, but his goals changed. He wanted to focus only on Houston, but I wanted to focus on Atlanta. So after that, I made a few offers, and then I met Ajay, and we talked, and we said, hey, let's try it and see what happens. And basically through Brad.
Yeah, it takes a lot of effort to get in an airplane, tell your wife and your kids goodbye. I'm going to go for a weekend. How many flights out to Texas did you have to do?
I come here at roughly around once in every 2 months. But during the first year, once I left my job in around 1.5 years back. And one of the main reasons was that I could see many of the deals in Atlanta that I was not able to tour. So part of the reason I left my job was, first of all, I was interested in multifamily, but also I was kind of missing out on, and I felt like I would be much more effective if I'm able to be more free and I can go to Atlanta whenever I want. So to answer your question, like roughly once in 2 months, but I used to go to Atlanta pretty often, and every time I would stay there for a week. And one thing I learned was that if you just plan for like 2-3 days and plan all the trips, it doesn't work. When you go there, a lot of deals come out of the woodwork. People, the brokers say, oh, by the way, I have this other deal. And one of those by the way deals is what eventually we got.
So tell me about Magnolia Woods is the deal you guys bought in Atlanta. Maybe tell us about how that deal came about and what you liked about that deal.
So Magnolia Woods came through a broker who was, I had toured many deals with him. And then, of course, with Ajay, we analyzed many other deals. So it was basically a relationship-based deal, right? I mean, so Barden Brown is the broker of that deal. Brown Realties, there are 2 brothers. I had toured multiple deals with those 2 brothers as well as him. So he was the one who got us this deal, purely personal, relationship-based. And the deal was interesting in the sense that it had lower occupancy, and the owner wanted to get out of it for some reason because he wanted to move his cash somewhere else. So that's why the numbers worked much better than other deals. So we were really interested in that deal. And so we went for that, and eventually luck turned our way. We got the deal.
I remember when you initially came to us, you were looking for a bridge loan on that deal.
Yes.
And so we were looking at probably 75% loan to value on the deal. Yes. And this was 240 units. And what was, I guess, when you brought the deal to us, what did we suggest in terms of changing on the loan terms to get you more leverage on that deal?
Yes, James, that's where you come in, right? I mean, you are the like Ajay likes to say, like, James is a magician. Paul also. So the amazing thing was that the offer that we had, it was working well with a bridge loan too, which is why we were interested in it. But then James comes along and says, hey, I look at the occupancy, and we can probably go for a regular Fannie Mae loan because of the numbers. And we were shocked. And when we looked at the term sheets that James gave, it was like so much better than the other term sheet. And so that was one big reason why the deal worked for us, because eventually the price went up, and still the deal worked for us because of the terms that you brought us, James.
James, tell us a little bit more about that, because I want to dive into that.
So the occupancy of the property had been anywhere from 85 to 90%. And so many people were thinking bridge loan, 75%. And Fannie Mae does have an exception in their occupancy sometimes where you can get a Fannie Mae loan even at 85%, as long as the physical occupancy is there and the economic occupancy is still above 80.
Again, explain to me physical versus economic.
So physical is the actual vacancy of the property, but then a lot of times economic is taking into consideration concessions and bad debt and all those other items to get to your actual collections. And so this property needed to be at 85% physical and 80% economic, and that's where it was in June and July. So you guys got it under contract, I think in April on this deal.
I think somewhere in
May maybe.
May 11th, if I remember correctly.
So we had even more time crunch because I think we wanted to close at the end of July.
Yes.
And so this was, I think, even the seller was thinking that this was going to go through a bridge loan. And so when we said, okay, we're going to take it through Fannie Mae, he wasn't necessarily happy about that. It was a little bit more paperwork for him, but it ended up, you guys were able to get probably a couple $1 million more
Oh, yeah.
in
Yeah.
loan proceeds than other buyers. And so you could come up a little bit on price and still make the deal work.
Yes, absolutely. Yeah.
No, when you came to the picture, basically it changed the whole thing. It changed the whole thing, because the reason is when we were looking into I know that when we both analyzed the deal, we were having two spreadsheets, one with the bridge loan and one with the actual when we refinanced the deal. Right. And when you came and we shared the data with you, and you told us no, you can directly go to Fannie Mae. And that's why that's why I keep calling you magician, because for us it was because when we were talking to loan broker in Atlanta, everybody was saying the bridge loan is the only option here. Right. And because we were able to get the Fannie Mae loan, that's why we were able to offer the price what seller was expecting.
Right. Okay.
And the good part is if you look at the rehab, $1.7 million rehab built into the loan. Right. Is an amazing thing to have.
Explain that one more time again, James. I hate to hit this again, but if they had done a bridge loan, would they have had to pay the fees all over again for the permanent loan? And by going right to the permanent loan, how much money do you think you saved them?
So there's a couple things. It was the bridge loan would have been probably closer to, let's just call it $9.5 million. And we were able to go out and get a close to $11 million loan right from the beginning.
Wow.
So that was equity that they didn't have to raise on the transaction. And then also Fannie Mae is a pretty low cost in terms of legal and in terms of origination fees, versus a bridge loan typically is going to be 1 to 2 points on origination, and then plus an exit fee, and then plus an origination fee again on the Fannie Mae loan. So that's probably another 3 or 4 points on, let's say, a $10 million loan. So there's a lot of money.
Yeah, he is a magician.
I know that. I kept saying it.
I don't think the deal would have really worked, to be honest, right? I mean, if you look at the bridge loan calculations, the deal simply would have fell apart because it started at, I think, 12 million or so.
Sure.
And ended up a little higher. So
we closed on the transaction in July.
August first week.
So when, after takeover, has there been any big surprises, or is it pretty much, business as usual? How's it been? Properties in Atlanta, you guys are in Dallas and California. How has the management of the asset been so far?
So in terms of surprises, we didn't really have a lot of surprises because it's the same property manager. That was another advantage that we had, because of which we were able to get much better numbers. So we work with S&P, an awesome property management company that I would recommend to anyone who is looking into Atlanta. They are now number one in terms of number of units. So they were the ones before, so we just transitioned from those. So the transition was very, very smooth. So in terms of surprises, I don't think there were many surprises. One thing we did note that Atlanta tends to be a little bit slower in terms of how they move. But part of the reason might be that here we are used to Brad's ecosystem, and all the vendors, they have a vested interest also, and plus there is such good relationship that they really do their best. Maybe that's not the case in Atlanta, but we are still going at a pretty good clip there.
And then part of the issue on this property, and I think this is why people were thinking it was a bridge loan, was they had some down units.
Yes.
Yep. And so it really wasn't necessarily a market occupancy problem.
Yes.
It was just that the seller didn't want to invest the money into these units to bring them up.
Yes.
And so now that you have the money, have you been able to bring those units up to market?
Yes.
Okay.
Yep.
Two of them, there are 10 down units. 2 of them are already leased, and 2 I think are pre-leased. So
Yeah.
Okay. So they're coming up quickly.
Like a high rent also.
yeah.
Okay.
Yeah.
Great.
What do you think about the Atlanta market? I mean, you're short-term players there, but what do you think so far?
I think Atlanta is in many ways very similar to Dallas. The 2 main criteria that at the top level that we look at for any market is, of course, landlord. It has to be landlord friendly, right? I'm in California. I don't invest in California because it's not.
Wait a second.
Tenant.
You're from California.
Yeah.
You learn from an instructor in Dallas, and you own a property in Atlanta. So you like Atlanta because it's similar to Dallas because it's landlord friendly.
Yes, that's true. That's it's landlord friendly, and 2 other criteria, which is population growth. Its population growth is very good. It's very comparable to Dallas, and job growth is also comparable to Dallas. So these are the three main criteria apart from other smaller things that you can add up to.
Yeah, I just want to go back to that. You learn in Dallas though, but it's 1 + 1 = 2 in Atlanta, 1 + 1 = 2 in Kansas City, and 1 + 1 = 2 in Los Angeles. So when you get training from someplace that's kind of not in your neighborhood, not convenient in Ohio or not convenient to get to in Denver, and you have to travel to some place to get education, I think there's a lot of value. That math is the same. That's why when you're asking about why don't you invest in California, because you learned when you already obviously knew that California, as our philosophy is live in California but invest in Texas or Atlanta, as you're proving up to me that it makes sense.
Yeah.
But the math makes sense that it's better to invest in other places than say California.
That's true, especially in multifamily. So that's not necessarily true for single family because the market is completely different there. But we're talking multifamily here, and for multifamily, at least the model that I've seen doesn't work there. I still know a few people who are making money, but
if you put down 35 or 40%,
yes,
you can cash flow. If you want to put down 20%,
yes,
you can cash flow.
Yes, I got some numbers for you. Like I was talking to this one guy I know who was in multifamily. He spent $388. I think his rehab was like $45,000 per door per unit, and he was like his starting property. It was like 10 units, and it was $388,000 per unit. And these were like units where there was no floor. Basically, it's like huge,
big value.
And he was getting like surprisingly, he was able to get 10% cash flow. I don't know how he was doing that, but
I did see an article that the odd pickers are picking Atlanta for Amazon's headquarters.
Yes,
so
yes,
that might be.
Okay.
So just to throw that out there, but let's move over to your second transaction. So I guess, did you find out about the Atlanta transaction first or the
Carlton?
let's talk about the Carlton transaction and what do you like about that deal here in DFW?
So I'm local to Dallas. So yeah, over the period, good relationship had been built with a lot of brokers here. So when me and Menon started working, so we had some kind of like our criteria that what kind of properties we are looking for. So definitely we wanted to have a property 100+ store so that it can be professionally managed. Class C, because that's where most of the money is, and in a good market, good area. And when this Fort Worth property in Carlton came into the market, so we started looking into it. We drove there, and when we saw that, this property is next to high school, in a very, very close to the major highways, like Chick-fil-A, one of the industry standard, opened a store like maybe less than 2 miles away from that. And when we saw the property, we kind of went inside. We saw that another thing which we found out about this is a owner who is running the property, means holding from the New Jersey.
Sure.
Right? He was not local, and he didn't have a management company. He hired his managers, and that's how he was running. So, but just by looking and knowing the information, we knew there is a lot of upside here. And then when we had a tour with our broker, in this case Bard and Nick from Marcus Millichap, those were the brokers. So when we did the tour, we got more information. And after that, we underwrote the deal. And after underwrote the deal, we shared this information with Brad. And Brad has his own criteria. If deal comes into that criteria, fits into that, then you go to the next step. And then definitely we get involved with you. We got our term sheet, and then we got a budget from our management company. In this case, Venner is the management company. So everything kind of like a fall in place where we want it to be. And we were able to see there will be like a cash flow. This is how much we can project our return in 5 years or 6 years.
Okay.
So things were kind of like in like where we wanted to be, and that's how we went there.
So this one had a little bit different scenario. So the occupancy that they had at the property, do you remember sort of what occupancy was? It was probably 95%.
95%.
It was pretty full.
Yeah.
Right. But I guess there's a difference between bodies in the units and the amount that they actually collected.
Well, that's called physical and economic occupancy. Didn't we just talk about that?
Yes.
So do you remember if a tenant wanted to pay the rent, do you remember how they had to pay the rent to the seller?
Oh yeah, so so like this guy, because he was a absentee guy and running from the New Jersey, so 95% was the physical occupancy. But when we look at the number, we found like $85,000 something they were collecting. And we don't know whether that was even real, 85,000 also, right? But there were a lot of things we found out which was kind of like not the standard. We want to run our business the way. Yeah. So a lot of tenants, they wanted to pay. So usually they had to send the money order or check either to New Jersey, or this guy who was running the show here, he had to knock on every day in the morning to the door of the tenant to get the money. And you know that when we took over the deal, the first thing he told me that, Ajay, if you want to collect the rent from this tenant, make sure that your management company or manager is knocking on the door of the tenant from 1st to 10. And I was thinking, what you are talking
So
about?
the beginning of the month,
Yeah.
so the 1st of the month to the 10th of the month, he
Yeah.
was knocking on everyone's door
to
trying
get
to
the
collect
rent.
the rent.
Yeah, which was like a challenge, and that's how the Venner management company, like a property manager, they did an awesome job, because our goal was that to clean up the tenant base here, and that's what we did. We had to evict like a good amount of tenant, and now. With the help of management company, we were able to fill those vacancies by a good quality tenant. So that's where this whole thing is kind of like. But we still have some challenge. I'm not saying that we are done, because it's 3 months into the operations, but we see a big upside here for this deal.
Do you remember what sort of roughly the rents were and what your rehab is going to be and what you think rents can get to on that property?
Yeah, so our rehab is $360,000 for this. And out of that, we decided to rebrand the property. So rather than Carlton, it will be called Red Oak Apartments, because the reputation of the property was not very good. Okay. So that's why we wanted to make sure that we kind of like we rebrand the property. We are going to repaint, and also putting money in the like a security, because the gates, we put money in the office. So if you go to the office, it is a very good, nice looking office now. We rehab the whole laundry facility. We put the pergola next to the office. So after the paint and everything is done, it will be a very nice property to take a look at.
All right, let me ask you a series of 20 questions here. How many KPs did you guys need on that property? Were they the same KPs, the key principals, as the one in Atlanta?
So in this one, we have 4, right? Me, Menon, and we have
2 other ones?
Two others, yeah.
And how many limited partners did you have in Atlanta and in Carlton?
So we had 4 there also in
KPs
There were
in
5
Atlanta,
KPs.
Yeah.
but then he was saying
How many investors?
investors in the deal.
investors. Okay. In Carlton, we have 17, right?
No. 27 total, and I think in Atlanta it's around 50, 51, something like that, close to 50
Yeah.
investors.
And how much rehab are you putting in the Carlton one? That's the one that's in Fort Worth. How much rehab on a per unit basis?
Around 400.
400.
Okay.
Yeah, 400K.
Okay. And where's that going into?
Mainly exterior, and interior we are upgrading as we go, because you know that we had a big turnover in the beginning. So all the evictions we are doing, which we had to do. So we are rehabbing those for the interior also.
So you're doing some of the interior rehab of the property, and then the Atlanta property? What
Yes,
kind of
so-
things are you doing on that property?
Well, Atlanta budget is pretty high, so we are doing a bunch of things. First thing we did was we brought those 10 down units up, because they were the premium 3-bedroom units. We knew that they were.
And why were they down?
They were down due to some water issues, water damage in that particular building. So I think he had fixed many of the units in that building, but he had just stopped
He left
working on
half
this.
of them.
Yeah, he
Yep.
basically, those are the buildings from which they were robbing the AC and all that stuff to give it to other units. So we have already done that. We are going to do a bunch of things. Let me just think through. The first thing is exterior paint. We are going to paint the whole property. We are going to do major renovations in the office. We are going to add a fitness center there. We are going to clubhouse. We are going to make some changes, furniture. The whole office will look completely different. Right now it looks very dull. One of the persons said that it looks like a funeral home, which seems right. But it will not look like a funeral home once we are done with that office. So that's one. And then landscaping, like the pathway, it's a huge property, right? So there is a pathway to the leasing office. The landscaping is kind of tired. We are going to work on that. What else? And we are going to add a dog park. We are going to add I think playground. We are going to make some changes on the playground. And we have done a bunch of deferred maintenance, right? We have a lot of deferred maintenance there.
Did you guys do any green program stuff? Any utility?
Yes,
Yes.
we are going to do
Waters?
that too. Yes, in both deals, in Carlton as well as in Atlanta. Deal.
And then did you guys have an inspector take a look at the property? Obviously in Fort Worth, because you're connected in Fort Worth. How about in Atlanta? Did you have an inspector go through it?
Yes. So we already knew one of the top due diligence guy in Atlanta who's just born there. I think he knows all the property. He's similar to you,
Yeah.
Paul. And he knows like every property. Oh, I've done this due diligence like 2 times, and all the he can tell you about every property. Perhaps not at your level, but I think he's pretty good. So we connected with him, and he was the one who helped us.
And during the due diligence day, we both were there, and we walked through the property along with him. Each and every unit means whatever we want to see, exterior, and those. It was a really good experience working with him, because he knows what to look into the property. And the good part is because he has done the due diligence of this property earlier also. So he had a history.
Sure.
So he knew what to look into this property.
Now, Menon, again, you live out in Northern California. How many times do you go out there to take a look at the property in Atlanta? And then how many times are you communicating with your property management company in Atlanta?
So we both have a weekly conference call on both properties, Carlton and Magnolia. And now Red Oak, and we are going to change the name of the Magnolia also to something different, Reserve at 2070. So we have weekly conference calls, and then we both go monthly, like we alternate every month, like once he goes, once I go. And I try to time it with Brad's event so that I can come to Dallas and go from Dallas to Atlanta, so that way save some time and money. So, but I think we would not have to go every month once the renovations are done or they are on our autopilot. But I think till the renovations are done, we are going to stay there. And one thing we are doing a little different, is that we are using one of the Magnolia units to, so that we can again save a little bit of expense and also get to feel how the tenants, live. So I found a few problems when I lived there, and those problems are being addressed as we speak.
Now, you live in Texas and you live in the Dallas-Fort Worth area, and that property is in Fort Worth. How many times do you go to the property itself, and how many times are you on the call with Wayner?
So we have weekly call with Wayner where we both are on the call, and I try to go depending on the need. I try to go there at least weekly right now, because we are doing a lot of rehab during this time. If there is a need for, like, I need to meet a contractor there, or I need to meet a management, there was something which we needed to meet to the Fort Worth city personnel, so I went there. So depending on the need, but I still try to go at least on weekly basis. But once everything is done, then I don't think so we have to go that frequently.
So a lot of people will do one transaction at a time, typically. Talk about maybe the challenges. Maybe there's some benefits, but benefits or challenges that came up when doing 2 transactions at essentially the same time.
Yeah, that was, I think, one of the first, I would say, in Bradstone Rockproof, if I'm not mistaken, like somebody closing. I think we got these 2 deals, LOIs accepted within like maybe a space of 3-4 days.
Yeah.
And we were really hungry for deals. We had done a lot of work before that, and we were not getting, we were getting very close, but we're not getting. So we just thought we should do both, right? Little did we know what we are getting into. So to answer your question, I think there were, as we discussed, there were challenges in both deals, and they were coming at sometimes simultaneously, sometimes at different times. So there was always, our head was spinning in both directions and multiple ways. And James was involved with us all the way, and Brad was also very much aware of it. So I think we could not have pulled it off without, James, without Brad, his team, Tom, Dante, right? All these guys, without this, there is no way that we could have pulled it off. But short answer is that if you are doing 2 simultaneous deal, make sure that you're prepared to lose a lot of hair, get a lot of gray hair in a short span of time. It was challenging, but we were able to do it. And obviously, the advantage is that I had 0 units in lead sponsorship, and from 0, I went straight to 348 units and learned a lot in a very short period of time, right? We went through those challenges, but we were able to overcome them, at least till the closing. And we are still dealing with some of the operations-related stuff. But
James, how did that happen? I mean, Menon didn't have any ownership experience prior to buying this property. I mean, how did you do it?
Couple things. So Jay has prior Fannie Mae experience, And so he was able to sign on the transaction in 2016. And then so he brought that experience to these deals. And then they also brought key principals who had Fannie Mae experience on deals of this size. So Park Ridge that Jay had purchased in 2016, that was about 100 units. And then Carlton was about 108 units. But then going up to Magnolia Woods was a little bit of a stretch. So that was 240 units. And so in order to do that, we brought in a key principal that had close to 1,000 units that he had signed on as a Fannie Mae. And so they looked at that. And then in terms of the third-party property management, that helped significantly. So
So you got 2 properties under contract, and how much hard money did you guys have in the deal? And at any time did you think about exit stage right on any of these deals?
Oh, yeah, definitely. So we had a very good amount of money in both hard day one in Carlton as well as in Magnolia, because that's how you get the deal nowadays, because there is no other way around, and we had to do it. And definitely, because for Carlton, because, we were having so many issues, so many times we thought maybe let's move on, but with the help of the whole ecosystem here, definitely including Brad, his mentor, and you guys like from Old Capital, we were able to focus on the upside of the deal rather than what is coming. Because when we found out, our leverage may not be that great in Carlton, that was the first thing we thought, because how we are going to do it? Because if we cannot do the rehab, what we are thinking, then how we are going to able to raise the rent and with our projections. But end of the day, it happened very good. So we had a very good amount of rehab, and not what we wanted to do, but at least we were able to do everything what we want to do, means exterior and also interior in the Carlton.
All right, let me ask the magician over here. Did he have any concerns or worries?
So I think for 60 days, I talked to you guys for 60 days straight every day.
Oh, yeah.
And we always just started with, which one are we going to start with?
Yeah. Oh, yeah.
Because there was always something going on with both of them. But I think one benefit when doing 2 transactions is that when you fill out the paperwork, when you do everything on one, you know it's coming around on the other one.
Yeah.
And so some people, if they do a transaction in the first quarter of the year, then they do one in the fourth quarter of the year, they almost forget everything that they had to do beforehand. But if an issue came up on one of the transactions, you almost double checked it on the other one to make sure that wasn't going to be an issue. And on this one, it was almost, if it was good on one, it wasn't good on the other.
Yeah.
And so it sort of balanced each other out. But, you guys did a great job of not only, being flexible, because a lot of deals in today's market, once you get under contract for the next 60 days, you don't know what's going to come at you. And so these guys were very persistent and, really called upon either us or other vendors to really get what was needed in a timely fashion. So both of these transactions had 60 days to close, but then when, whether it was seller financials or the lender needed a little bit more time to request an extension, these guys, stayed cool under the fire. And I mean, the seller on one transaction, I think, wanted to charge us like $5,000 a day.
Oh, 7,000.
7,000 a day for every day that we didn't close.
Yeah, and that was a better seller. That was the easier seller.
That's crazy.
And the best benefit, which just one thing I would like to add, James gave us a checklist of the documents that what we need to
which we never paid attention to, Ajay.
Yeah, which was at least it gave us a very good idea what is expected from us, and we kept gathering all the documents, what is next, what is the next, and as you said, we collected the document for one deal, and we knew this is good for the another deal also. So that helps us a lot.
Any advice for somebody that's looking back? You've closed 3 transactions. You've closed 2. You've been in the middle of a passive investment, $3,000 or so. Any advice looking back to somebody that's thinking about trying to get into multifamily? Would you start off as a passive first, or would you go, as my analogy always says, would you go to become the captain of the airplane first, or the backseater, or I guess it comes down to individuals. But what do you think now, guys?
So for me, basically, because I still have a day job, and who is started as a single family, then passive, and then started as a deal sponsor, what I will suggest to anyone, don't lose your hope, because if you are persistent, you are trying to do something, things will happen. Because my first deal, I started with Brad in 2015. My first deal, which as a deal sponsor, I did after 1.5 years. Because June 2016, that's where I closed. But I was very persistent about putting all the offers. And the another thing, definitely, I will suggest anybody who wants to do it, build your own team. Like have a relationship with the broker, with the lenders, and definitely if you are part of the group like Brad, so build your own team, because you don't know when the deal will come. If you will build your team after you have a deal, then it is too late. So keep working on your relationship, and that's what.
Yeah, so I'll echo many of the things that Ajay said. I think the number one thing, if you want to get into multifamily, is a no-brainer. You have to have a mentor. Without a mentor, I would say don't even think about it. I mean, unless you want to, like, if you're going for a deal which is big enough, and if you want to raise money from others, do not do it without a mentor. You will, and Brad Sumrock is pretty much as good as it gets, in my opinion, because the mentor, he or she will teach you what to do, but more importantly, she will make you not do those stupid things and lose money. Not just your money, but other people's money, right? And you're talking about a lot of money here. We are talking about multi-million-dollar deals. So that's number one thing. Once you have the mentor, I think if you're trying to find your own deals, I would say, because I did remotely, so I would say the biggest thing would be to build relationships. It's a relationships business. And so you need to build relationships with the property manager. You have to have a solid property manager and with whom you are consistently working. So before I met Ajay, I had built a relationship with S&P. So that was very handy to us, and the broker relationships, right? And with Ajay also, Ajay was also there when we were building the broker relationship. So combined, I think these relationships are the most important thing, without which you cannot do it. So relationships, and that comes for fundraising also, right? Fundraising is all relationships. So it's a relationships business, and you got to have a mentor. I think those two things, if you keep it, and of course persistence. I was looking in Atlanta. Before I even met Ajay, I was pounding the payments, and I think some people were having fun at me too. But I just kept doing it, and with Ajay, we looked at so many deals. We came to best and finals. We were number two, but we are not getting it, and then luck turned our way. So being persistent is definitely. Without that, I don't think you can do it.
James, do you play to win?
I think a lot of people play not to lose. They'll put in an offer, but it won't be aggressive. They won't put in hard money on the deal. They won't be aggressive on their timelines. They won't be aggressive on the financing. Yeah. And so a lot of times, like as bankers, we are conservative, but a lot of general partners, you have to play to win in this market right now. And I think a lot of times you can't just sit back and sit on the sidelines. You got to get in the game and start. Every transaction, I think you're going to learn something.
Oh, yeah.
And you can't always just wait to hit grand slams. You got to get out there, hit singles, doubles, and triples, and get some people on base.
Yeah.
And so I think you guys have done a great job and have been very persistent in getting these done. So congratulations.
Thank you,
guys.
James. We couldn't have done it without you guys, so obviously, and without Brad Sumrock and his team.
Absolutely fantastic.
And without each other, if I must say.
You couldn't have done it. But another question I have before we wrap this up is that if you wanted to do a deal, we're just spitballing here, what do you think the amount somebody should get started with? Is it $200,000? Is it $300,000? $400,000? If you want to be a deal sponsor, if you want to run the show, what do you think people should have in their war chest to buy an apartment building these days?
I think it will depend on what kind of deal they are looking for. If they are looking for a smaller deal, because see, when you submit a LOI, most of the sellers, they want to see how much money you have to show proof of funds, right? So if you have funds your own, that's great. But if you don't, then you should have your team who can show you proof of fund. So sometime what happened, you may not need your own fund, but if you have a group who can help you out there, then definitely that's a...
Yeah, so I think, again, it depends on the deal size, but James has given us some guidelines, right? Typical hard money nowadays is what, 1% at least?
1% of the purchase price. So if you're looking at, let's say you're looking at a 100-unit transaction here in DFW, it's, let's say, 60 a door, so you're looking at $6 million purchase price. The general partner is going to have to put down $60,000 day one, and then the loan app fee is anywhere 20 to 30,000. So now you're in for 90,000, and then the attorney's not going to do anything till you send them a check. So that's another 10. So it's 100,000 right off the bat. And then you're going to do due diligence and start raising money, opening bank accounts. So, and a lot of times after 21 days, they're going to want another 50,000 or 60,000. So now all of a sudden you're 150 into the deal, and it's been 21 days, and that's a $6 million deal. So these guys did a $6 million deal and a $12 million deal. So just imagine how much was at risk.
Yeah, so that's another reason why you want to do it with one more person, right? I mean, if you take, I mean, there is one or two people who have been super successful alone, but they are the exceptions. I mean, mostly you share the rewards, but you also share the risk.
I agree. Guys, thanks for coming in. We do appreciate your time. Boy, some great ideas that are coming out of you guys. I mean, you living in Bay Area, you living here in Texas, and having a property in Texas and also in Atlanta. Some challenges with putting the deal together. Thanks to James, the magician, able to put the deal together. It's fantastic. So we do appreciate your business. We do appreciate your time and kind of explaining a little bit of the backstory to the transaction. James, anything coming up in the Old Capital world?
Just real quick, if people wanted to reach out to you guys, maybe just let them know your email real quick if you want to.
Yeah, so this is Menon. You can connect with me at my email. It's Menair Properties, MENAIR Properties @gmail.com. You can also reach me on my Facebook. If you are on Facebook, it's facebook.com/Menon, which is MENON.
That's an easy one.
Yeah, for me, this is Ajay Sharma. People can reach to me by my email address. It is AIMNEXT Realty. Is AIMNEXT Realty @gmail.com. And definitely I'm also on Facebook, facebook.com, I think Ajay Sharma. AJAI Sharma.
Okay, great. And if you have not received our white paper, you can go to oldcapitalpodcast.com and click on the link there on the right-hand side to request our white paper.
Sounds great. Thanks, guys, for coming in. Jay, Menon, thank you very much. James Eng, always a pleasure. Thanks for coming in. We appreciate that.
Thanks, Paul.
I'm Paul Peebles. Have a good day.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.